States, and that's why we're going to see a lot more of this going forward.
It's like the ultimate anti-Buffett rule, right? Buffett wants to tax the rich, and they're saying, we're rich and we don't want to pay.
Yeah, but, you know, avoiding the heavy taxation, sorry, but I mean, even at current tax rates, the U.S. personal tax rate is still far below where you see in many other parts of the world. And there are plenty of loopholes that wealthy people here in this country use to avoid paying that high rate. I don't necessarily
think it's the personal tax rate. It's the dividend rates that are going to go up, and that's why they're leaving.
Ooh, all right. Lot to talk about tonight. We're back in 2. This is Rewind. This is Bloomberg Rewind. I'm Adam Johnson, in for Matt Miller. Let's focus on the direction of the U.S. economy and hear from Drew Mattis. He's senior U.S. economist at UBS Securities. Bloomberg editor-at-large Tom Keene asked Drew why he remains optimistic about America.
What's important, I think, is that we are near where we need to be in order to pull down the unemployment rate. And the reason I say that is because the unemployment rate's falling in the growth along the growth that we've had.
What do we need to do to just get back to where we were 10 years ago?
Well, I mean, if we took home prices back to where they were, I think everyone would be happier.
That's the delta's just home prices?
No, I think it's, you know, everyone, you know, for 10 years, basically, everyone had this idea that if you invested, it went up. If you bought a house, it went up. Everything went up. And when everything's going up, it's very easy to look out and say, you know what, things are pretty good. Easy to get a job. If you wanted to get a job, all you really had to do was walk into somewhere and ask. And now everything's harder. But this is more of a normal environment. This is the way life used to be, right? This is the
pre-leverage
expansion. This is a deleveraging economy still. In a deleveraging economy, what happens? Cost of capital is going up, not down. Investment's going to get harder. It's going to get harder to do everything. But it means that for people who are participating in the economy, it's going to be okay. It's not going to be what they were used to. And so then we have to worry more about things like wealth disparities and obviously equality of opportunity.
Is there a government policy that can get nominal GDP up 100 or 200 beeps to really give us an oomph here?
I don't think you want to see one. You're starting to sound like Paul Krugman today in the Times. No, I don't think there is. I think this is a matter of letting things sort themselves out. You know, people have to be rewarded for taking risk, and people have to be penalized when they get it wrong. You know, honestly, markets are more efficient than that than anyone else could possibly hope to be.
The other great debate I see in this economics, besides consumption, and Drew's written a lot on this, labor participation, the defining change. 2 camps. Our labor participation is down, it's normal, and there's going to be a new unemployment level, and we'll get there, it's no big deal. Those away from you say labor participation is down, and it's not a good thing, and it shows that it's going to be a long time for recovery. Discuss that debate.
Well, I don't see it as a debate. I see it as algebra. You know, to be like any good Wall Street economist, I stole my work from the Fed. Smarter economists than I did it, and predicted it back in 2005. I think what has caught people off guard. I think there's this inability to believe what's going on is because it just happened to coincide with 2008 and 2011. So we have this dramatic change in the U.S. economy. At the same time, a dramatic change in demographics is happening, and people have a hard time reconciling the two together.
Let's hear from Mike Norman of John Thomas Financial and Joe Brasuelis of Bloomberg LP, 2 economists, so we could have our own little in-house debate. Joe, you've actually done a lot of work on that labor force participation. Fewer people are being counted, which makes the rate appear lower.
That's right. And Drew is right about one thing, is that roughly 25% of the decline in the labor force participation rate is due to the demographic change. But where I might differ from Drew...
Just for the benefit of the viewers, what do you mean by demographic change?
The retirement of the baby boom is specifically what I mean. But I think that there's a number of other factors that are going on here. First, that we've got people who are second income earners in the household who've lost jobs and aren't going to return to the workforce at the reduced wages and perhaps less desirable jobs. Second, we've got people staying in school longer in order to avoid becoming unemployed after school, after they graduate. And then we've got a lot of people going back to school, and you can see that in the student loan data. And I think those are the main sources of what's going on.
In other words, the rate is artificially low for those reasons. What do you think?
Well, I'm a little bit stunned when he says, you know, you just got to leave everything alone and let it sort itself out. I mean, that's kind of an absurd, you know, proposal there. Look,
it's a free market stance.
Well, it's not a free market stance, okay?
What? Non-interventionist?
No, because there's certain entities also dictate a certain amount of demand. It's not completely a free market. But let me say this. You want to raise it 100 basis points GDP? It's a very simple thing to do. Government spending and investment is the second largest component in our economy. You raise that up, you raise the output of the economy, you put people back to work. I could fix this economy in 10 minutes if I had the ability to engage fiscal policy to the degree that is necessary. Look, back in 2009, the Chinese did a stimulus of 15% of their GDP. That would have equated to something like a $3 trillion stimulus here. The growth was so fast as a result of that now they've had to try to peel it back, okay? It's a very simple matter to address demand.
They have money and we don't.
We don't?
They could afford it.
We've run out of dollars?
So you're saying we print more?
There's no limit to the amount of fiat currency that a currency issuing nation can issue.
All right, this debate's getting good. Don't go anywhere. We're back in 2. This is Bloomberg Rewind. I'm Adam Johnson, in for Matt Miller. Well, for a look at market-moving stories that came out after the closing bell Friday, all of Bloomberg's top headlines, let's go back to Gigi Stone. Gigi?
Well, Adam, Mark Zuckerberg continues that cross-country tour he's doing to pitch Facebook's IPO. Today, he told investors Facebook is taking steps to make money from its mobile user base. Now, some investors have balked at buying shares in the IPO. That's ever since Facebook said advertising growth hasn't kept pace with the gains in users, many of them through mobile devices. Now, sources are also telling Bloomberg Avon is evaluating a due diligence request from Coty, the perfume company offering to buy Avon for $10.7 billion. Coty wants information right now about Avon's future products, its global expenses, and its legal liabilities. And the closing bell brought no relief for J.P. Morgan Chase today. 24 hours after the bank revealed that $2 billion trading loss, Fitch downgraded both J.P. Morgan's short-term and long-term debt. The bank's outlook was revised to negative from stable by S&P. Meanwhile, Fed officials are gathering more information about the trading position that led to the loss. And Adam, sources telling Bloomberg Fed officials have actually known for weeks.
You wonder what they've known in detail. All right, thanks, Gigi. We will check back with you later for a look at the next week's roadmap. All right, for more on J.P. Morgan, senior Washington correspondent Peter Cook got reaction from Michigan Senator Carl Levin. Senator Levin co-authored the Volcker Rule, which would limit trading by the banks.
This was not. This was an economic hedge. It was a hedge that related to the entire direction of the economy. That is clearly not permitted under the Volcker language, but the regulators are again under big pressure to come up with a weak rule which would allow for so-called portfolio hedging. That's just an escape from what the language of the law intends and I think very clearly creates.
Do you think what's happened now with J.P. Morgan should end that debate once and for all? Regulators now have the evidence they need to finalize the rule in the way that you believe it should be finalized?
I hope it stiffens their back and that their final rule does not have the kind of a loophole which their proposed regulation did, which was an exemption for what they called portfolio trading. That totally undermines not, again, just the intent of our law, but the language of the law itself.
There is a lot of area of confusion here because of the business that they have to do, the market making, the hedging. There is legitimate hedging to be done here, that this is difficult. Even those who want to comply say this is going to be difficult. Do you just not buy that?
Well, is it complex? Of course it's complex. Is there a clear line between hedging, which relates to a specific risk of a specific asset? If you are into oil stocks and you want to hedge, you can hedge against the risk in your portfolio. But that's not what Diamond did, according to his own words. This was an economic hedge. He was hedging on the direction of the economy as a whole. That is not allowed under our law, and if the regulators tolerate that, they are ignoring the clear language of our law.
Let's bring in Bloomberg's own Dawn Kopecki. She's been working tirelessly for the past 24 hours. Dawn, you've been all over this story. I can't even imagine when the last time was that you slept. How do you think this thing's going to evolve over the weekend?
You know, now that Fitch has downgraded the stock and, you know, we know the Federal Reserve is looking at the company, over the weekend, you're going to see, the company is going to have to answer to some of these things. I'm sure on Monday morning you're going to see a lot of stories, including ours, looking at these issues, analyzing it. The things just got incredibly worse for JP Morgan. They went from bad to worse, and they can only get worse from here at this point.
You know, the amazing thing, Dawn, is I really only counted one downgrade today by an analyst. A lot of the analysts were saying it's bad, it's ugly, but hang in there, this too shall pass. I mean, that was the commentary out of both Barclays and Citi's analysts.
There were at least 2 downgrades that I noticed, and analysts tend to be a little late to the game, on Enron, a little late to the game on Fannie Freddie. I covered Fannie Freddie for a long time, and there were analysts that had buy recommendations on the stock right before the weekend before it was being seized by the federal government. They still had buy recommendations on the stock before their shares were delisted. And so equity analysts, not a lot of people, they need to make commissions. They need to maintain good relations with the companies they cover. Some of the equity analysts have a more skeptical view of the company. Some of the analysts, like Charles Peabody at Portales Partners, downgraded the stock in March. So he thinks that the stock right now is about where it should be, which is kind of in a market perform area. There's no doubt, however, that investors do not like the news. If you looked at how far the stock dropped today, and you look at what, some portfolio managers are saying, although the size of the loss isn't that great for a bank that has a $2.3 trillion balance sheet, it's a large loss for a single position. And that's what they don't like. They also don't like that they don't understand this position, that the bank themselves didn't understand this position. So that level of uncertainty and that breakdown in internal controls is something investors do not like. So you may see more pain for the company in the coming weeks.
Yeah, Dawn, hi, this is Mike Norman. And we had a guest on earlier who kind of said the same thing, that a lot of this has already been discounted. I find that hard to swallow. I mean, this is, as you said in your opening, it went from bad to worse. I mean, I could see really a bloodbath in this stock on Monday, which could spread out to the entire market. I'm just kind of surprised at how sanguine people are at, well, this is already built in. I really don't see it that way.
Yeah, I think that people need to look at what's been said, look at all the investigations going on, and then make their own determination. It's certainly not a good thing. We know that JP Morgan and Jamie Dimon have been incredibly good risk managers to date. However, this shows several cracks in the foundation of the bank. And so that's what concerns a lot of people. A lot of people like Paul Miller at FBR Capital Markets. He's one of the most accurate analysts out there. Charles Peabody is also an incredibly good analyst. And Charles Peabody said he thinks that the stock may have peaked in March for the next 2 years. He sees this as a drag on the stock for the next 2 years.
All right, Dawn Kopecki of Bloomberg News, great work. I hope you get some sleep over the weekend. We'll look forward to reading your latest article, probably coming out several times over the course of the weekend and, of course, Monday morning. All right, up next, we will go inside what many people call the place where dreams come true. We'll go live to Walt Disney headquarters. We'll be back. This is Bloomberg Rewind. I'm Adam Johnson. Well, all week long, Bloomberg has given you an insider's look at Disney. Our chief national correspondent, Carol Masser, touring the parks, exploring the media outlets, and speaking with the company's top executives, including CEO Bob Iger. She joins us now from Walt Disney headquarters in lovely Burbank, California. God, Carol, I almost feel like Johnny Carson when I talk about going to Burbank now. But Carol, take it away.
Adam, thanks so much. Well, it's been a great week for Disney. As you know, the company releasing its Marvel's The Avengers. It had a record opening weekend, and in all, it's already sold about $800 million in terms of box office receipts in 16 days. So great, obviously, in terms of that release. It also released earnings. It was up 21% so far this week. Investors liked the news. They sent the stock up about 6% in what's been a down week for the overall market. So why would anyone want to leave the company? It's a question I put to Bob Iger, who has said he will step down as CEO in 2015. Here's what he had to say.
It's a very personal decision.
Okay.
It's not one that's easily made. These are jobs that are wonderful when you have them, but they're also very demanding.
Yeah.
And I, believe that it's important to really balance your life in many ways. So that's one factor. And thinking about what's right for the company. Change at the top can be very good for companies. Fresh perspective, fresh air, give opportunities to other people.